Good morning. Really great to have you here. Really looking forward to our discussion this morning, talking about financial innovation for climate resilience. As Elias said, I'm Kelvin Massingham. I'm Director of Risk and Resilience at FSD Africa. And I want to start this morning just framing the discussion and start actually with a thought experiment. So the thought experiment is, imagine we're in 2035, so it's just over 10 years from now, and you're looking back at the last 10 years, and you're answering the question, what's made the biggest difference in terms of reducing the impact of climate change in Africa? Is it mitigation or is it adaptation? By mitigation, I mean kind of managing our impact on the climate, reducing our CO2 emissions so that we reduce the greenhouse gas effect that's warming the atmosphere. So things like changing to renewable energy. So that's those interventions, or is it adaptation, by which I mean managing kind of climate's impact on us. So doing things that reduce the risk, reduce our vulnerability, adapt to the climate changes that have already happened. So just think about that for a moment. The next 10 years, critical kind of 10 years, what's made the biggest impact? And it's a debate, right? And often people have very differing views on this, but I would strongly argue that adaptation and resilience is the most important thing. Those interventions are going to be the most significant over the next 10 years. And the reason why I say that is because if you look at Africa's emissions, we're only at 3% of global emissions, so a very small amount. And the International Energy Agency projects forward on various different scenarios kind of Africa's contribution to global emissions over the next kind of 10, 20 years. And it never really gets above 6 or 7% on almost all scenarios. And so actually the biggest impact on kind of reducing CO2 emissions is really going to come from the current big emitters and mainly from the global north. And Africa's contribution is likely to be fairly small. And so I'm not saying it's not important that we transition energy in Africa. Obviously, access to affordable energy is a very key driver of economic growth. I'm not arguing that. I'm just saying in terms of climate change, it's probably going to be a small contribution globally because a ton of CO2 emitted in Africa contributes globally. But adaptation is a local thing. And we know Africa is the most vulnerable continent to climate change. And so it's really, really important that we take action to mitigate these effects and to start to adjust to the warming that we've already seen. We're already at 1.2 degrees. And the thing is that we know that from the science that we're going to probably exceed 1.5 degrees, that we're warming very rapidly. 2023 was the warmest year on record, and we're continuing to see that trend continue. And so we know from the IPCC, the Intergovernmental Panel on Climate Change, that this is what's happening. And so there's an urgency to act. We're not certain about a lot of things, right? We don't know who's going to win the American election in a few weeks. We don't know how things are going to play out in the Middle East. On the financial side, we don't know what's going to happen with interest rates or exchange rates or inflation. I mean, we have some models, but it's difficult to predict. But on climate change, we're pretty sure. The science is pretty unequivocal that we're at least on track for 1.5 degrees, and so we know that there's going to be serious impacts in Africa on food security, on water security, on migration, zoonotic diseases, the transfers of diseases from animals to humans, like we saw with COVID-19, as climate change and nature loss brings humans and wildlife into closer contact, is going to increase. Conflict driven by competing for food and water resources. These things are all major kind of challenges for Africa that we're going to have to face in the future. And so there's an urgency to act now, because we also know from the IPCC that the adaptation measures that we implement now that are still kind of effective and feasible will decrease in feasibility and effectiveness going forward as we warm. And so there's a window in which we're able to adapt, which we need to take advantage of now. And so in order to do that, it's very important that the financial sector plays its role, because we need to get finance into these solutions, and that's really the goal of this panel today. The challenge that we face is that actually the finance is way insufficient at the moment. So Africa is the most vulnerable continent from a climate change perspective, but only gets 3% of global climate finance. And if you look at the quantum of that versus what's needed, if you compare sort of what the nationally determined contributions, if you add all those up for Africa, so these are the contributions that African countries are making towards the Paris Agreement, the finance required is about 300 billion a year, and it's currently at around 30 billion, so 10% of what's required. And if sort of further challenge is that most of that is public finance, only 14% comes from the private sector, and 80% of that goes to mitigation, so like to renewable energy. So there's a very tiny fraction of finance private finance that's currently flowing to adaptation, which is something that we desperately need to change. And in the previous panel, we're talking about some of the challenges that exist in this space, in terms of data and in terms of kind of business models for the private sector where there's revenue streams, in terms of understanding kind of what is a good adaptation project. But we know that there's a huge business case here, because if you look at kind of the cost of inaction, if you look at sort of if we do nothing, what are the economic losses going to be? The present value of those way exceeds the sort of investment that we need to do now. And so it's once you understand that, it's kind of a no-brainer to invest. But the IPCC also tells us that there's immediate benefits to investing in adaptation in terms of food and water security, not only sort of in the natural capital space, but also in the urban context. And so part of what we want to talk about today is how do we create the business models and the solutions that enable the private finance to flow. And we've got many great examples, and so I don't want to take any more time, but really looking forward to hearing the examples from the panel, who are really experts in this space, and we selected them because they're actually doing the stuff on the ground in Africa. So really looking forward to hearing from you, and Elias, over to you.
Thank you. Thank you very much, and again, a warm welcome to this panel. Somebody asked me, what is climate change? And I had to go to my village. And one of the most interesting things is that a couple of years back, there was the existence of granaries, whereby my grandmother would basically store food in a simple structure. And whenever we could face any calamity, then there was always something to navigate that particular challenge. Now, these are very interesting panel because we are kind of going to look at how then do we look at innovative financing, because there are so many traditional models that have been tested before, and these traditional models in one or the other have fallen short. And this basically means that we really need to come up with very innovative mechanisms in which we can build resilience in the continent. And as Kelvin has mentioned, the continent faces a very big impact, particularly when we talk about climate. At the same time, there are mechanisms such as financing that really needs to be innovated in ways in which we can create inclusive and, I would say, sustainable models that will transform this particular continent. Further that, we've been looking at various models such as sustainable agriculture, and I know we are going to get a few insights around that, renewable energy, as previously the previous panel have kind of spoken about. But the key goal is then how do we come up together to address this particular challenge. So I'm honored to have with me a great panel that will help us dive into these particular issues and kind of explore what are some of the key examples that we've seen across Africa, and how then can we use these particular examples to catalyze and change and transform the continent that is in a position that can really cause a big change across different ecosystems. So with me, I have Marvin from Catalyst Fund, and basically Maxime from Catalyst Fund. And I just want you to kind of bring us into context. Can you briefly describe some of the innovative financing mechanisms that you've encountered, and how then these have been implemented in enabling climate resilience in Africa?
Sure, thanks a lot. I'll talk specifically about the one that we're deploying, which is basically venture capital to back climate adaptation innovations across the continent. It's one of the different options. As Kelvin was saying earlier, the financing gap for climate adaptation in Africa is massive. Somewhere between 100 and $300 billion a year. So it's huge. We need everything here to contribute. On our side, because we're focusing really on early stage innovation within climate adaptation, VC and venture capital is a fairly good mechanism. It's actually what's used elsewhere in the world as well to finance climate adaptation solution and also some climate mitigation solution. I mean, if you think of innovative things like direct air carbon capture and things like that, it's financed by VC at the beginning. So it works well for that, and it's about 30 to 40% of the financing for climate adaptation early stage innovation comes from VC. I think it's a good mechanism to start with. It's probably not enough to scale because we're talking about not just asset light solutions, right? When you talk about a startup that does cold chain solution to reduce post-harvest loss, for instance, we're talking about trucks, we're talking about fridges, we're talking about equipment, and that needs quite a lot of financing. So, and VC, in the mind of people, has been more created to back asset light, software only solutions. So there's a bit of a shift that needs to happen. But I truly believe, and we're seeing it with our portfolio of 22 companies already, that VC can work for climate adaptation solution, even if it's not just software and asset light. So happy to dig more into examples there, but yeah, that's our preferred mechanism at the moment, I would say.
Yeah, so I've seen Ted, you're nodding, and definitely I want to come to you. What are some of the challenges? Because Maxime have talked about some of the opportunities that VCs do provide. So what are some of the challenges do you face as InsurTechs in trying to build Africa's climate resilience?
Yeah, great question. Quick introduction for everyone's benefit. So,
fantastic.
My name is Ted Pantone. I'm co-founder and CEO of Turaco. We're an insurance technology company focusing on being in the resilience business, right? Trying to help people get insured. 90% of our customers have never had insurance before. We're insuring more than 850,000 people across Kenya, Uganda, Nigeria, and Ghana. And from a climate standpoint, we're not a climate company. We're not focused on being a climate resilience company. I don't sell crop insurance. I focus on selling things that people want to buy, which crop insurance is not one of them. So that may be opening up a debate for later conversations. But at the core of what we do is trying to protect people from the risks that they face in their lives, and those risks are increasing, right? As I'm sitting here today and thinking about my parents who live in Florida who are at risk of flood for the second time in 2 weeks, but I'm at peace, right? They have 100 safety nets to protect them from all of the things that could go wrong in their lives. And I've lived in East Africa for 17 years. My friends there do not have the same level of resiliency and protection. So that's really what we're focused on doing. To your question on what are the challenges on the VC landscape, it's very hard to raise as a InsurTech in a unproven vertical that is unlikely to create 100x return because it needs to be slightly more asset heavy, not quite as asset heavy as some of the physical product companies, but it's more expensive to get there than a typical software play. So when we went to San Francisco to try and raise venture capital for Turaco, we failed, right? There was not money that wanted that 100x return that was interested in coming into our business. So we fortunately, by God's grace, have fantastic investors that have more of an impact mindset. So that level of, I think, softness of capital was required for us being able to raise capital to do what we wanted to do. I think we're going to get people a good return because we're very commercially minded and focused on building a good business. But I think that's the challenge when you're looking at trying to do an insurance or InsurTech play on the continent at the moment. Is the likelihood of you getting 100x return is just far lower than the typical kind of venture expectation will be able to deliver.
Right. Let me come to you, Sitara, CEO, SCBF, and you work a lot of impact and kind of looking at how then do you enable climate resilience projects to kind of support communities. Maybe just to get it from you, what are some of the case studies where innovative financing have significantly impacted communities in Africa, and what are some of the learnings that you've gotten as an organization?
Thank you, Elias, and thank you for asking me to be on this panel. We are, just as background, we are an organization that basically funds earlier stage companies, and we use catalytic capital. We have three main instruments. They're returnable grants, impact-linked finance, and technical assistance to develop financial products or services. So when you think about the Africa continent and you look at maybe Taraco, or you look at other organizations that are really trying to get capital in these markets, the banks are too big for them to be able to access that capital. Microfinance is too small for them to access capital. And so they're left in what we call, and Elias and I have the same view on this, but from different angles. They're in basically the valley of death, as Elias calls it, and what I call, or what we call, is the pioneer gap. They're pioneers that are looking to grow, and they don't have the various types of capital. And so coming back to your question, we have developed that suite of three instruments to really cater to the needs. So if you imagine a company that is starting up, companies in these, or enterprises in this space, are looking for three things. They're looking for capital, they're looking for networks, and they're looking for capacity, technical assistance. And that's where our three instruments have come in. The challenges that we have seen in some of these instruments is really around getting access to, so in technical assistance, getting access to the right type of capacity for them to grow, the right type of networks for them to access, whether it's the regulation that doesn't support insurance at the time, or is doing an insurance sandbox, as Bima Lab has done a lot of, or whether it's actually going to scale and understanding what that scale is. So for us, it's really been around those three things. And then the other components, so from the enterprise side, when we're doing an impact-linked finance, we're saying we want you to achieve a certain level of impact. And the capability of these organizations, because they're in these early stages, to actually say, this is the impact, and this is how we measure it, and these are the KPIs, it is pushing them. And so we see it as sort of a growth along the way. I mean, the last panel talked about a capital continuum. We think of it very similarly, but more on the philanthropic capital. So back to you.
Great. Very good insights. The pioneer gap, the valley of death. Banks are too big for innovators. At the same time, we talk about micro finance institutions are too small for them. And that basically means that there is need to create mechanisms. And I want to come to you, Sarah, from FSD Kenya. What are some of the innovative financing mechanisms that have proven effective in mobilizing green finance that maybe you are working on from an organization perspective, and how can that basically bridge this pioneer gap? I like calling it valley of death.
I think, Elias, we agree on that I also like calling it value of death. I think that's, and it's a risky place to be for many innovators, because it's either they access the funding, or we are almost saying this is the end of the business. So I think I begin by introducing FSD Kenya. I nearly said Africa. FSD Kenya, we operate within Kenya and the financial markets in Kenya. So we are specifically looking at what are the innovative financial solutions that can solve the challenges that the economy faces. And here we are looking at the people we care for most is the most vulnerable communities and the most underserved communities. So we are looking at solutions that basically a bank is not providing, the microfinance may not be providing. And we sometimes even want to work with the financial institutions like the banks to see what other solutions do you then come up with to respond to the needs of these underserved communities and very vulnerable communities that will not be getting the financial services from a traditional banking institution, an MFI. And so one of the ones that I have closely in mind, when Elias was talking about he went back to his village, I went back to a conversation that we had about 3 years ago with Sun Culture. So we go for a field visit with Sun Culture, which is a solar company in Kenya, and providing agricultural solutions in Kenya. And they have a client somewhere in the outskirts of Nakuru in Kenya. And it seems to be a very isolated client. And we keep asking the questions, why does it look like the neighbors of this client do not see what's happening? Because we went there during the dry season, and for sure the farm of this farmer was thriving. But the question was, then why is this not having a ripple effect? Why is there no one coming to ask the question, you seem to be producing all year long, but we are not doing the same? And this then brought the conversation of what's the challenge? Why are we not getting the solution that we are hoping? Sun Culture has a disruptive solution, but it doesn't seem to be getting to the market like it should be getting to the market. And one of the challenges that we discovered very quickly was the upfront cost that was needed. Sun Culture are in business, so they have to price their risk. They have to look at their risk model, so they need an upfront payment. They have a pay-go model. And what Sun Culture did here was to look at what other models do we then try to experiment with to ensure that we have more access and see how many more people are able to access these solutions. Because not only is Sun Culture a solar solution and we are looking at a mitigation strategy, but what Sun Culture is doing is food insecurity that has become the norm right now in many African countries is one of the things that they're trying to handle and deal with. So through support from Alpha Mundi Foundation, who had received a grant from GIZ, and FSD Kenya coming in to provide a second loss guarantee to Sun Culture to say, take more risk, provide require less from these people. Let them give you just something small for them to access the pump at first. And let's see what happens. Are they going to repay? Are they producing for them to now take this to the market and be able to repay you? And you're not taking the full risk. You'll take part of the risk, but we'll have a fund that provides you the guarantee that you will be able to cushion the company from the losses that may come with this. And what this blended finance mechanism did to Sun Culture is open a market that they would not have then been able to service. And I need to add a second level of what we've been able to continue to do with Sun Culture is the last 2 years, the other thing that we've done is the carbon markets. And what did we want to see with Sun Culture here? We wanted to see how do we then look at this innovative financing mechanism in the carbon markets that seems to provide solutions, but the end user, we're not clear yet what's in it for the end user. And the conversations are always around the nature-based solutions, community, but when you look at solar, the community is not touched. So, but how will the end user benefit? So we put in money as FSD Kenya in Sun Culture and said, if we were to simulate a carbon market and look at what you will make from the carbon markets, would you be able to reduce your interest rates for the pay-go model? And we did it with a select clients from them. And for sure, this was one very successful project. And I'm happy to report that Sun Culture is now currently almost will be able to, in the next few months, to trade in the carbon markets if they've not started yet, because they've been verified now. And we are hoping that this is something that they will be able to continue to do, that the end user will now get a benefit by reducing the interest rates that they pay, which means more people are able to access, and then the payment period is also reduced. I think I'll give that example for now, Elias.
Right, thanks. And that basically, again, brings me to Maxime. And, Sarah has given a clear example of kind of transformation and really trying to support the innovators. And most of the time when you talk about innovation, particularly within the African continent, just beyond looking at funding, there's a way these particular funds need to be structured. So maybe I just want to talk about what are some of the strategies from a catalyst fund perspective that you've deployed to support these innovators to kind of navigate, again, the pioneer gap. Let me be quite good in this instead of calling it value of death.
Yeah, thanks. I think the Sun Culture example that was given is a very interesting one. I remember, so in a previous life, I used to work with an organization called GSMA, and we gave a grant to Sun Culture. I think it was 2014, something like this. So it's been an interesting journey of, basically a climate resilience and mitigation startup, navigating the different financing mechanism, all the way from grants to VC, to blended finance. Recently, they raised the Series B as well. So, yeah, I think that there could be an interesting case study, definitely on Sun Culture. Hopefully, we're trying at our level with Catalyst Fund to make this kind of journey a little bit easier now, by providing equity investments very early on. So we are often the first VC check in most of the startups we invest. We're happy to take that risk. But the way we do it is we offer it together with what we call venture building. So not just cash, but also basically a period of 6-7 months of very hands-on support to the companies. We don't like to call that an help. It's actually a way for us to de-risk our investment as well. We have seen it works. We have done it with over 90 companies now. Actually, Turaco was one of them many years ago. And that basically helps us to de-risk this investment by working with the entrepreneurs on things that maybe are not urgently needed for the business to grow their revenue next week, but that are extremely fundamental for them to scale their business over the next couple of years. So we work with them on setting up the data dashboard, improving the tech on the back end as well, setting up OKRs for the team, building a sales strategy, setting up a board. All these things that a lot of these founders are not necessarily experienced with, because there's no reason why they would have experience with it. So that's really what our team try to bring to the table beyond the investment, and we think it's quite needed at that point when you invest in this valley of death or pioneer gap, as we say, especially in sectors that are increasingly specific. I mean, I talked earlier about carbon capture. We invest in startups that do agroforestry at scale. I mean, land restoration. They are almost scientists, founders. They cannot be experts in their field and also in the financing world. I mean, it's a lot to ask from founders. So that's where we can come in and open these areas for them and support them in the journey. So yeah, again, cash is not enough often, and that's what we have experienced, and that's why we're putting this mechanism in place.
Right. Thanks. Cash is not enough. Venture building is important. Holding hands is important in Africa. And let me come to Ted. I know you've been in the BIMALA program, and there are a couple of things that you've managed as an organization to achieve. Again, just to give you a brief of BIMALA, this is an ecosystem that supports insurtechs across the continent to navigate the pioneer gap, basically trying to close the protection gap around climate, health, SME, and gender. So just to get a brief on how, beyond funding, there was that support that definitely you benefited from. How did this transform your business value proposition and enabled your organization to grow?
You know me pretty well. You know I'm a natural skeptic. So when I hear about all this philanthropic capital coming in, like all the alarm bells go off and say, like, is this making a difference? Like, is it worth it? I think when I look at our trajectory as a company over the last 6 years since we started, without the philanthropic capital, both as a few very small grants, we haven't raised much grant capital, but lots of technical assistance, we would not be where we are today, without a question. So I'll brag on both you guys, because you've been a big part of my life, big part of our company's life. When we got into Catalyst Fund, my last business was a Pizza Hut franchise. So I'm not a technical founder. I didn't know how to build the technology. We hired some engineers. We had a team that was doing things, but you guys recognized this guy needs a CTO. He can't afford a CTO, but we're going to deploy a part-time CTO that is in our ecosystem into the business to help make sure that the technology gets crafted properly. So that was a very direct example of something that transformed our technology, answered the question, what, were we building the right thing? Was it scalable? Would it last? So thank you. And then for FSD, with the Bima Lab program, Pizza Hut business is my last business that I started. I'm not an insurance expert as well. So coming into this, we hired actuaries. I hired people to help us manage the regulatory landscape internally to an extent, but the depth of a relationship that the Bima Lab team had with the different regulators in different markets and helping us navigate that landscape, helping us see through how to apply properly for the licenses that we needed to actually make our business profitable, which we're knocking on the door of profitability. Very nice to not be raising money to survive anymore. But yeah, I credit the Bima Lab program, which I don't know who gave money to that, so thank you for whoever gave money to this program. But that really transformed our ability to make our business work in these different regulatory contexts that we didn't have experience with as a company. So I think these are things that we probably could have figured out with time, but we might not have had the capital to survive that long. So I think the fact that we had these non-grant facilities come in and actually help us solve these real problems in our business was transformative. And I actually believe that. I'm not just saying that because my friends are here.
Right, Sitara, Swiss Capacity Building Facility. As the name talks about capacity building. In fact, when I came across Swiss Capacity Building Facility, I thought that it was only for capacity building. But over time, we've seen that you kind of structure your solutions around providing capital and enabling capacity building. What is the role of capacity building just beyond innovative financing, and how has that really transformed some of the projects that you've deployed across the continent?
So for us, capacity building is really about developing a financial product for the low-income client. So we've seen a lot of innovation, whether it's data, more data that's available, that technology is available, and we're finding that there are new solutions that are coming into the market. And so many of these entrepreneurs, kind of like you, are saying to themselves, we want to play in this space. We see an opportunity. We want to do some good. But they don't have the expertise in-house. And so we fund that expertise. We enable them to be able to access that expertise. In terms of an example, we've worked with, similar but different from Tarako, but we worked with an organization called Oko Mali. They're an index insurance company that works in Mali. Their Oko Finance is the overall company. And when we actually gave them technical assistance, they had probably a client base of maybe 400, 500. And today they have over 10,000. And that was over a period of 15, 18 months that they were able to do that. Not only did we give them that technical assistance funding, our network, we are a public-private platform, and what we were able to do is within our process where we have our members who are large insurance companies, the Swiss government, they're able to play a role in these companies. And so what they're able to do is actually, in the case of Oko Mali, the Swiss government, because they were aware of the project, were able to actually introduce Oko Mali to the regulator so that they could have a discussion about what is the regulatory environment, what are the regulatory hurdles, and how they can implement. They were also, the growth that they experienced in their client portfolio was really based on an introduction that Zurich, Allianz Insurance provided. They introduced them to a cooperative and multiple cooperatives, and they were able to scale very quickly. And so technical assistance, for us, it's technical assistance plus plus, and some of those pluses are not as tangible until we actually go and double click on those projects. So I hope that answers.
Yeah.
Question.
Please.
I know Oko quite well, and Simon before me as well. Just bouncing back on the comment that Ted made earlier, because Oko is doing crops insurance, right?
Yeah.
And Ted said, we don't sell crops insurance because we sell products that people want to buy. So I'm just curious to hear your thoughts on that, because it's been a big question for us. We want to do more in that space as well, but we have been facing similar challenges. How do you move the needle on crops insurance? And so yeah, I'd be Curious to
Like,
hear
it just
your,
admitted it's
your
not
respective thoughts on that.
It's not really fair because they're not here to fight back, but fundamentally speaking, farmers don't recognize the value of crop insurance to the price point that it costs, right? And that's true globally, right? If you try and sell crop insurance in the West, it's massively subsidized by any government. So it's really a business to government play or business to donor play in the markets where we operate, and that's just a different business than what we've built as Turaco. We're building something that is entirely focused on delivering value to consumers that they recognize and are willing to pay for. So it's a different business. I think there is a model for it, but you have to recognize that forever, not just for an initial portion, there needs to be a subsidy on the crop insurance or index insurance, whatever you want to call it, product to make that product make any sense for the value proposition to farmers.
But wasn't that the same with health insurance some time back? I mean, like,
Exactly.
selling health insurance to people that have never been insured, across Africa is also really hard because they don't see the immediate value.
I think the difference is in how long philanthropic capital needs to be involved, right? So I've just described our background, which is we needed philanthropic capital to get to where we are, and probably continuing for a season, hopefully not much longer, but we're very close to getting some funding from DFC, a very low cost loan, right, which will give us the capital that we need for the next few years. But the difference in crop is that doesn't go away, right? There's never a world that I think anybody has been able to paint a picture of me for that doesn't require a subsidy for crop or index insurance. And I think that will only increase as climate change continues to progress and we have greater stresses upon the things that insurance would cover. So there's just not a business model that requires that doesn't require philanthropic capital there forever.
I would agree. I mean, there's a couple of, I think, points that are important that you've raised. One is, what you raised, is people don't know about insurance necessarily. And so part of our programming, we include client education as such. And I think that's a really key component. In terms of the subsidies do exist. There are, of course, they exist, but there are models where subsidies don't exist. There's a whole, I mean, this is a whole separate panel, I think, for some other day, but it's a whole discussion on, the sustainability of subsidies, whether they should be there or not. I mean, like you said, in the North, 20% of farmers there's 20% subsidies for farmers on average, if not more. What is that for the African context, for example? But I think the important thing that, as we come back to that question about climate, it's not going to change. Floods, droughts, the climate change effect is going to increase in magnitude and frequency. And it's not enough for us to say that solutions don't work. And it's our job to be able to find solutions. That's where, that philanthropic capital plays in. And I think we all want there to be a solution. It may not be there today, but we've got to keep trying, I think.
I describe the insurance that we're building as like a very similar touch point to maybe microfinance 20 years ago, right? The Grameen model was there. People were starting to figure out, okay, there's actually a business model in this. I think we're at a very similar point with the medical and life insurance products that we sell, where they're not subsidized, right? We're making money off of selling these insurance, and I call up 100 farmers in rural Western Kenya, 60% of them buy our product. Right, so there's actually a lot of demand. Customers understand it. Customers are willing to pay for it. There doesn't need to be a subsidy there, but we wouldn't exist today without the subsidy behind Turaco having gotten us to this level of innovation.
Absolutely.
Right, a very interesting conversation in there. Let me then get to collaborations, and I want to go to Sarah, and you can pick it from that particular point of subsidizing climate,
Yes.
because I think it's quite key for the continent to think about that. So what is the role of collaborations from the government to the private sector, to the regulators, to innovators? What can we really put together to enable Africa tick when it comes to building climate resilience?
think it's very hard to have a conversation on telling even the government, the private sector, this is what you need to do on climate when the basics have not been met. So it's hard, and hence the insurance conversation. How do you tell a farmer to take insurance for their crops when the little they have, they just want to survive the next season? So collaborations are not something that we can even debate about. We have a role to play as the DFIs, other non-governmental organizations, and also the government also needs to come in to partner with institutions that first have the technical know-how and also have the capital to deploy either very low-risk capital or some, in many instances, also grants to come in to respond to some of the challenges that climate change presents. And the first thing that I'll want to mention is a program that we are running as FSD Kenya. We have a $1 million project with the county governments. And what we are doing with the county governments is to look at their resources and see what are the resources within the county governments that could form a project that could form a business that responds to climate issues and responds to the challenges in climate. Could the counties be able to do it without our support? No. They are not interested to put their resources there, one. And the other thing, there is no motivation, because why would we want to take a risk as the county governments when we have priorities to make sure there is food for the people? We need to make sure the hospitals are well equipped. So we are coming in to make sure that what needs to be done will be done. And we did an assessment with the counties, 10 counties in Kenya, and the assessment was what are the resources that we have, the green resources that you have as the counties, and how can we develop commercial businesses out of this? And we know out of the long list, a very long list that we have, we are going to end up with maybe 5 that are commercially viable. And that doesn't mean the other 15 from the 20 long list are not projects that need to be done, because these are projects that may not immediately have commercial viability and be very attractive to a commercial investor. But if you look at it in the long haul, there is an impact that these will have in terms of providing food, ensuring that we have clean energy, ensuring that there are better health outcomes within the counties. And one of the things that we've done in terms of collaborations is to ensure that the government is on board, because we began this project as a green bonds initiative, but very quickly we realized that the macros are working against us. The counties did not have the infrastructure, and also the national government was not willing to bring in the guarantee for the counties to float the bonds. So this became a very hard conversation to even have with the regional governments, because you're telling them, we are bringing in more debt to you in an economy that is already feeling that we have a debt strain already, so we cannot be putting in resources to come and structure more debt. And we quickly have tried to work with the national government and private sector partners to restructure this, and that's a process that we are doing to ensure that we restructure it into green finance. So if we are reaching out to if we reach out to the World Bank and we talk about solar solutions for hospitals, then we are drawing the whole outcome solution and showing what does this mean to better health outcomes, which is a parallel that we are drawing from the effects of climate change. We are talking about food security, access to water. So it's different projects and bringing in partners from different spheres to see how do we develop solutions that finally benefit the person that is most affected and worst hit by the effects of climate change.
Right. Before I go to my last 2 questions, I want to bring you guys into the conversation. And maybe if there's a question, we can take one question in the room. And I've seen Munir. You know, is there a mic?
Yeah.
I think there is something that is working on climate. And I just wanted to get some insights from you, Munir, from Kifia. How is that particular project coming along? I know you trying to do something on climate in Ethiopia, particularly with the smaller farmers?
You are putting me on the spot. So I think it tallies to what everybody's saying on the table. Agricultural insurance is difficult to do, full stop. And without subsidy, it's almost impossible to scale. But what we are now finding more interesting is to embed that insurance into what farmers would want to have. So what we are doing is we are now bundling it into fertilizers or other types of inputs. So it has some residual value beyond just risk. So and then what we are now experimenting also is to expand that insurance to cover other risks, the credit risk itself. So farmers can borrow more, so that underlying insurance would be very interesting for the farmer. So these are the two things that we're experimenting with, and we are now also expanding the portfolio so that the portfolio becomes a bigger pool for it to become sustainable. So we are extending it to insure into credit and MSME in other sectors. So just not farmers, but manufacturing and service. So and agro-food processing up the value chain. So it's really about looking at what that insurance would cover. And I agree to what Ted was saying is that it has to bring value that is tangible to the farmer. And that's what we are experimenting with. And I think for the first time have much more traction than the last 6 years.
Fantastic. Thank you. Any question from the room? Right, there is a hand at the back.
Hi, my name is Mohammed. I work for Bloomberg. I was just wondering how exposed you guys feel to sort of the global economic situation and what you guys might be doing or how you feel like you could shield yourself from these types of externalities. Do you feel kind of at the mercy of you know, credit risk or you know, foreign exchange risk externally? Do you feel like there's a way to approach it at this moment where you could be shielded from it in the future, or is it more beneficial to be kind of more exposed and more integrated, and you know, thus at the mercy, I guess, of these trends? Thanks.
Right. Anybody willing to take that?
I don't mind. I mean, the nature of externalities is you're exposed, right? So like, there's no way to avoid being exposed to changing interest rates and other geopolitical pressures. We've diversified our business into being 4 different countries, so that's trying to diversify the risk a bit, and then you make hay when the sun shines and try and tighten the belt when there's very expensive capital to be found. So I think that's just the nature of that from a innovator standpoint, is you try and realize the reality of the world that's around us. But I mean, we had planned on expanding into Egypt at this point, but what's happened with the pound in the last several years has halted all of those plans. So I think you just have to be very practical about where you're trying to expand to, and that's the customer suffers from those effects, unfortunately.
Can I follow, sorry, from your perspective, do you have to reinsure internally, or do you feel like you... Sorry, mine's coming. Oh, sorry. So I just, since we're on the insurance aspect, do you feel like you can reinsure, do you feel like you need to reinsure externally? Do you need to resort to, I mean, I don't think reinsurance, correct me if I'm wrong, is a big business in Africa. Do you feel like you need to resort to a lot of reinsurance in Europe and elsewhere?
Quick introduction to insurance in Africa. Just as many insurance companies there as there are anywhere else in the world. All the big brands are there. They're just focused on the wealthy, right? They're focused on the corporate business that makes good profits for them, and reinsurers exist there as well. So there's a robust reinsurance market, a lot of different players, and we have no issue reinsuring our risk.
I think, let me mention something that what happens with externalities is that it really drives innovation and thinking outside the box. And for the first time, and let me talk for Kenya, for the first time this week, I've had a conversation from the wholesale lenders, debt lenders, trying to think about local currency lending. And for me, that was a win. And because the hedging costs are really skyrocketing. And this is a conversation at the beginning of the year nobody would have thought would be had amongst investors. So I believe what externalities are doing is making us think, because there is nothing we can do about it. Our currencies in Africa will keep on fluctuating. So it's up to us to think about what are the solutions that we have, what can we do to ensure that we continue doing business. Our economies keep on growing and stabilizing to some extent. So that's one of the examples that I think is making me feel hopeful. Yeah.
Right, so maybe I want you guys to be the prophets in the next 5 to 10 years. And my question is, what trends do you foresee when it comes to innovative financing for climate resilience? And the second thing is, I want you to talk about, what are some of the immediate actions that we should take to basically enable Africa to build its climate resilience? So maybe I'll start with you, Sitara.
I think what we'll see going forward is more innovative financing instruments. And as we start, and as Sarah, you said, as we start to see how do we deal with these externalities, we will see different forms of patient capital coming up. We'll see also capital that is very tailored to the stage of the company. I think traditional finance will change significantly, both from the types of instruments that they provide. So the debt, equity, they're all easy, and I'm a bit against equity. I know it has value, but when you look at a small company and somebody's trying to get your sweat equity from there, I know the argument is if you don't take that sweat equity, then there's no company, and so yes, we'll settle for it. But I think we need to think differently about these things. And I think, so that tailoring of instruments to the stage of the company and the type of company is going to be critical, taking into consideration those externalities.
Thank you. Ted?
It's a tricky question. I mean, I think there's a lot of trends, I think generally an increasing capitalism, right? More free-floating currencies, less, I would say, like dumb philanthropic investments, right? People are making more investment-oriented decisions with philanthropy. So I think the future is bright, and particularly in our space in insurance, I think a lot of the work that you guys are doing to get regulators to think differently about how to do insurance for the mass market for the poor, I think is changing the narrative of what is possible in increasing the core resilience, right? The fundamental insurance kind of risk protection for folks that just haven't had anything like that in their lives before. So I'm very bullish. I hope and believe that Traco is going to be a big part of that story as well.
Sarah?
I think for me, in the next 10 years, I think we'll see more local capital, and we're going to be seeing more local solutions. There is a lot that's going on in the African continent that keeps speaking to we need for us to understand the challenges that Africa is going through and be able to structure solutions that respond to those challenges. So I'm looking at very innovative solutions and very innovative financing that is Africa-led. Yeah, thank you.
Maxime?
A lot of wise things were said already. There's one thing we don't need to predict because, as Kelvin said, we know it's going to happen already. It's the fact that temperature will increase across Africa, probably plus 3 degrees in the next 10 years, plus 0.3 degrees in the next 10 years. So that's the fastest ever, the fastest globally. But I also want to, hope that we will move away from just the climate vulnerability narrative of Africa and look at the opportunity for Africa to drive climate resilience and adaptation solutions. I mean, I think some of the great innovations we can see in this space will come from the continent. We have seen, the capacity of Africa to leapfrog in so many sectors, banking, telco. I think the same can happen in climate adaptation. And that's really what we believe at Catalyst Fund. That's why we are, taking risk in backing solutions that are outside the box. And linked to that, I think we will see an increasing trend of venture capital being, more inclined to back things outside the traditional VC comfortable zone, I would say, which is software, asset lights, and so on. When we're looking at the types of innovations backed by climate tech investors in Europe and in the US, they're just backing hardware, basically. You take Breakthrough Ventures, these guys are just backing very much hardware, assets-intensive businesses. So I think we will see this trend happening also in the continent, and I'm very hopeful about that. So that, I think it's already happening. We're seeing right now in 2024, 45% of the startup funding in Africa went to climate tech. It's the highest share it's ever been. So this is already a trend in motion. So I'm very optimistic about this.
Thank you very much. And again, I appreciate your insights. And what is coming out is that Africa is promising to really leapfrog this challenge of climate change. And that requires a lot of collaboration, a lot of blended finance, and also insights that will ensure that it becomes an inclusive, innovative continent. Again, we are aware of the opportunity around the young population that is always looking into becoming the solution for that continent. As we define solutions out of the challenges that Africa is facing, there's always the star at the end. Thank you very much, and we enjoyed this particular session. Thank you.